Good morning, everyone. This is Rob McDougall from Zhang Financial here with your economic update. Today is Monday, October 7th, 2024. So let's take a look, do a recap of some of the economic activity last week. It was a huge week in terms of economic data that was released. We'll start off by talking about unemployment, and that was a big theme last week. But the employment, one of the employment metrics, the jobs opening called JOLTS, the number for August came out, and the job openings actually was much higher than expected. So expected to come in roughly 7.7 million, came in at over 8 million. So that was good. Initial jobless claims actually came in a little disappointing. Follow previous 3 weeks were better than expected. Initial jobless claims came in at 225,000. Expectations were 220,000. But Friday was the real action. So that was non-farm payrolls, unemployment rate, average hourly earnings. Big three. And this was a massive blowout in terms of non-farm payroll numbers. The expectation was 140,000. The actual came in at 254,000. Now we'll take a look at the reasons why in a moment. But that drove the unemployment rate down. Unemployment rate was expected to come in at 4.2%. It came in at 4.1%. And average hourly earnings, you'd like this to be higher for consumers to be able to spend more. It was. It was expected to come in at an advance of 0.3% month over month. It came in at a positive 0.4%. Month over month. So the non-farm payroll numbers, we are really challenged by this metric. The last year and a half, the numbers have looked a little funky and erratic. We had a stretch of 15 months where 12 of those months, the actual number beat consensus significantly, but we revised down previous month. Makes it a little suspect. This number, the 254,000, looks really high and doesn't seem to be confirmed by some other data. So let's just go through a few things. The enterprise number, service enterprise, is the BLS, Bureau of Labor Statistics, going to companies asking, did they add or remove jobs? So the other is the household survey, which we'll talk about in a moment. So the enterprise survey came in at a positive 202,000 new jobs added in services, much of that low end. Manufacturing was actually down 7,000. Healthcare and education up 81,000, and government up 31,000. Now that's where the disconnect is. 31,000 new government jobs. Actually, if we look at the household survey, which is the BLS going to individuals and asking them if they lost a job, added a job, that number was off the charts higher. So the number of government workers tracked by the household survey was up in the month 785,000. Now, if you take out the COVID recovery month, there's never been a month like this. So 785,000 new jobs, according to the household survey, in terms of government jobs. Really looks a bit suspect. So we'll keep looking at that. I'm not sure how that's going to play out, but the strong labor beat looks to us a bit suspicious given many things, including the timing of the election coming up. But we digress. So what happened to the expectations of GDP growth with that big beat on the labor number? Actually, the Atlanta Federal Reserve took down their expectations for growth in the third quarter. They had been at a positive 3.1%. They dropped their expectation to a positive 2.5%. In terms of inflation, the 10-year break even, it moved a little bit. It was up 8 basis points to 224, but that's a really low number. Again, that's the expectation of average inflation over the next 10 years. 2.24 seems awfully low. Fed funds, this is very interesting. So the expectation of 50 basis point cut during the November meeting. The week prior was about 35% odds of getting 2 cuts. Now it's 0. And 12% chance of no cut at all. So bond market is betting the Fed is going to be less aggressive than people thought just a week ago. Now, when we take a look at the end of the year and what the Fed funds future have priced into it, the odds of getting at least 3 more rate cuts from where we're at right now by the end of the year, 3, the probability is 7.3%. Why is that important? The week before, it was 47.4%. So again, and I think this is good, expectations by investors on Fed rate cuts has really moderated over the last couple of weeks. So, given the economic data last week, the blowout labor number, how did the markets respond? Not a lot, not much difference in U.S. equities, although it definitely hit the bond market. So S&P 500 last week up, call it 25 basis points. So decent week, but nothing major. When we take a look at the international, and this is very interesting. So again, S&P up 0.26%. The developed market ex-US, that index was down 3.31%. Emerging markets, however, was up barely 0.41%, but 25% of that index is China, and China had another massive stock week last week. It was up 11.53%. So now China, their stock market was negative just a month ago. Since then, we are now at a positive 35% year-to-date return on Chinese equities. So I'll just finish off on a couple of them in terms of equities. U.S. S&P 500 for the year up 21.6%. Developed markets ex-U.S. up only 8.38%. And even with this very large China reversal that we've seen, emerging markets still at 15.2%, well below the S&P 500. So what did happen last week in the biggest movement, bond market. So yields backed up quite a bit. 2-year was up 36, these are large moves. The 2-year was up 36 basis points. The 10-year was up 21 basis points. So the U.S., Bloomberg's U.S. aggregate bond index was down 1.25%, and long-term bonds were down over 2.5%. So on a year-to-date basis, in terms of fixed income here in the U.S., total return for the Bloomberg U.S. aggregate bond index still positive, 3.4%. Now let's take a look at some of the economic activity that will be released this week. Thursday is the big day. Thursday is core inflation. We'll get the inflation report, the CPI, and we'll also get initial jobless claims. So in terms of inflation, the headline inflation number, that's expected to improve for the month of September. Month of August, it was positive 0.2. Month of September, it is supposed to have dropped to a positive 0.1%. In terms of core inflation, prior month, month of August, up 0.3% month over month. That's expected to drop to a positive 0.2% month over month. In terms of jobless claims, that's expected to be exactly where it was last week at 200, or a little higher than last week. Last week it was 225. It's expected to come at 230,000. Friday, we get the PPI, core PPI, and we get the Michigan Consumer Sentiment. In terms of the PPI, the month over month, that is expected to improve as well from a positive 0.2% in August to a positive 0.1% in September. In terms of core, same thing, a downtick in that. It was a positive 0.3% month over month in August, expected to be a positive 0.2% for September. The Michigan Consumer Sentiment Index, that'll be coming out. That's the October reading. Last month it was 70.1%, and we're expecting just a slight increase in that at 71. So that's it for our economic recap. We thank you very much for your attendance and hope to see you again next week. Thank you.